Welcome to Objective 2 in Unit 6 of Accounting 3310. In this unit, we're going to pay particular attention to items that reduce the value of gross sales on the books of a company. The sales price at the time of customer order and delivery may be different than what is actually paid, even by the trustworthy customer. At the time of the original sale, who knows whether the item will be returned or whether the customer will be able to get the discount for early payment? How do adjustments to revenue appear in financial statements? Students will be able to make adjustments to sales for discounts, returns, and allowances. We're going to be looking at three particular sales reductions in this objective. First, sales discounts. These discounts are a way of encouraging early payment of accounts receivable by giving a discount. The accounts used are sales discount if one is using the gross method, or sales discounts not taken using the net method. First, we need to know exactly what we mean by the word discount. The word discount is used in other contexts that are not related to these kinds of sales discounts. Trade discounts refer to a way of maintaining a single price list that applies to a variety of customers who each pay a different percentage of the list price, usually based on volume. Sales are recorded net of trade discounts at the time of sale. Once a sale has taken place and been recorded, further discounts for early payment, those are these sales discounts. The terms that are used are standard. That is, there'll be a number followed by a slash followed by another number. What you need to remember is that the first number is the percentage discount, but they don't include the percentage. One easy way to remember is that discounts are relatively small, and so the first number is going to be something like 1 or 2 or 3 or 4. That's the discount. Nobody is going to give tremendous discounts for early payment. The second number after the slash is the number of days. The number of days is going to be a larger number. It may be as small as 10 to encourage people to pay within 10 days of their purchase, but it could be 30 or 45 even. 2/10 means a 2% discount if paid in 10 days. Net/30 means that net or the whole amount, that is 0 discount if paid in 30 days. After 30 days, it's going to be late, and that's not discussed here by these sales discounts, but certainly there could be late fees added in. The gross method assumes that sales are going to be paid after the discount period, and so they're recorded as the full amount. For example, if we record a sale that takes place on October 30th for $100 with terms of 3/10 net 28. The journal entries that will be written at the time of sale will record the entire sale in total. Then, when the payment is received, if the payment is received within that 10-day discount period, then the customer only has to pay $97. They're getting that 3% discount on the $100. But we've got an accounts receivable on our books for a full $100. So what do we do with that other $3? Well, that means that in fact, at the time we recorded the sale, we overstated how much we actually were going to receive. And so this sales discount of 3% then is a contra revenue account that reduces sales. If payment were received after the 10-day period, then the full amount would be paid, and so it would look like our usual credit sale. Let's illustrate the net method next. This method assumes that the customer will pay within the discount term, and so the sale is recorded subtracting out the discount to start with. Here's an example of a similar sale. The sale here is recorded at the $97, so we take the discount out right off the top in recording the sale. If the payment is received within the 10-day window, then that's exactly the amount of money that's paid, and we're recording 97. If the payment is received after the 10-day period, though, the customer is going to have to pay us the full $100, but we've only put $97 on the books as accounts receivable. What is that other $3 credit? Well, what we have to do is increase our owner's equity. This is sales discounts not taken, and it represents an other income source of our company from financing. So this represents a financing fee for allowing someone to delay payment for those 10 days after the sale. Sales allowances is another concept that affects the price of sales. Customers are given reductions in sales price when there are difficulties in the transaction, but the customer decides to keep the product. Perhaps there's a dent, or the wrong color was sent, or the shipment was late. The account used is sales allowances, a contra revenue account, similar to sales discounts, which was also a contra revenue account. In our example, a customer complained about a scratch on the back of the refrigerator delivered on November 10th. Rather than return the refrigerator, the customer accepted a $30 reduction in the sales price. That sales allowance is a reduction in revenue, so it's a reduction in owner's equity. It gets recorded as a debit, and it reduces the amount that the customer owes us, so we're reducing accounts receivable. If the customer had already paid, we might have a cash out for that credit amount. Sales returns are another reduction in sales. Revenue recognition can incur in some cases even though the customer still has the right of return. Usually, we don't record revenues if there's significant uncertainties, but right of return is one of those standard features, so that if a company has been offering the ability to return goods for many years and many months, then it's not an uncertain amount anymore, and the company can go ahead and accrue what the expected sales returns are going to be and record revenue. The conditions for revenue recognition to exist, even though there's a right of return, are the following. The price is substantially fixed or determinable. That is, we need to know exactly what the price is in order to measure this revenue. The buyer has paid or is obligated to pay, and payment does not depend on resale. So here we have a final customer who has purchased these goods, and either we've received cash already or we've got a bona fide accounts receivable. This does not apply if the buyer is only going to buy it from us if they can find someone to buy it from them. If that's the arrangement that we have, then it's not a genuine sale, because the person who has the product in his hands is not the final customer. Next, the title needs to still be transferred to the buyer. The buyer bears the risk of theft or damage or loss. The buyer has to be a separate entity from the seller. That is, we can't count it as a sale if we ship it from our warehouse to our store. And there can be no significant obligations to bring about resale that remain with the seller. So the seller can't be responsible for selling it through to a final customer, or we have that same problem that we have sold it but not to somebody who's likely to keep it. Finally, the amount of future returns can be reasonably estimated. This can be met in a surprising number of cases. Most of our usual situations with retailers are going to fit all of these conditions for sales returns. If conditions are met to recognize sales returns, then a transaction has a right of return, and sales returns are accrued at the end of the period based on estimates of expected returns. If these conditions are not met, no sales are recognized until the right of return expires. Here are the journal entries that go along with recording sales returns. ABC Company sells $100,000 of merchandise during the period, all of which have a right of return that meet the criteria. ABC estimates that $10,000 of returns are likely to occur. This may be one of our features, so if somebody says, I don't know if that color will go with my living room, you tell them buy both colors and return the one that doesn't fit, right? So we've got a lot of returns that we expect, and it's a part of our marketing to our customers. The sale is able to record it as a regular sale. That is, increase cash, increase owner's equity for the sale, and then the customer has taken the inventory, so we decrease inventory and record the expense of cost of goods sold. At the end of the period, we accrue the sales returns that we expect to take place. Sales returns is a contra stockholders' equity account, a contra revenue, and it decreases the amount of sales. Then when a return actually takes place, what we're doing is we're identifying this one return as a portion of the returns allowance that we've set up. So we're not recording that return as a sales return at the time it's returned. We're recording it as a reduction to the allowance for sales returns. And of course we've gotten the inventory back, so we record the inventory to increase our inventory and take out the cost of goods sold. This illustration shows that sales returns are recorded on an accrual basis and reduce revenue. Net sales, then, is measured as gross sales less sales discounts, less sales returns, less sales allowances to get a final value for net sales. Net sales is the more important figure for analysis and is often the starting point of an income statement. Managers, though, track sales discounts, sales allowances, and sales returns closely in order to improve their operations. This is the end of describing the additional features of recording reductions to sales.